All right. Very popular topic right now are temporary buy downs. What exactly is a buy down? Now, a buy down is truly an attractive feature to consider under certain circumstances, like when interest rates are higher than, say, historical norms, and there's a high probability that rates are going to rebound, are going to fall to a point where someone's unable to refinance. A buy down is as a way to offset a buyer's mortgage payment for a predetermined number of years, right? 1, 2, or 3 years. Now, it's not a rate discount where the rate is permanently reduced for the life of the loan, but it is a temporary reduction in a buyer's mortgage payment. All right, so how does this work exactly? And let's just use a 2-1 buy down for purposes of this discussion, as 2-1s are certainly the most popular of the three options. And we'll just say 6%, right? So your loan is underwritten, it's approved at 6% at that payment. Year one, your required monthly payment is based on a 4% interest rate. Year two, it's based on a 5% interest rate. And then years 3 through 30 goes back to its normal 6% rate. Now, the idea being that by year three, the market will have improved to a point where you're able to refinance into a lower rate. So how exactly is a buy down cost covered when it comes to closing? Typically, it is structured as seller funded, right? It uses some kind of seller concession, although it can be covered by the buyer, or it can be split between the buyer and the seller, right? So you might say, okay, how exactly is this calculated? And I wanted to give you an example so you can see exactly how that is. And let's just say a 4% or a $400,000 loan amount with a 6% interest rate. It gives you a principal and interest payment of $2398.20. Now, using a 2-1 buy down, the first year the buyer's payment is calculated at 4%, or $1909.66, a difference of $488.54. Therefore, offsetting this payment for the full 12 months would bring us to $5862.48. So the second year, the rate goes to 5% with a payment of $2147.29, creating a difference of $250.92. Now, over the next 12 months, over this year, that offset goes to $3011.04. Therefore, over 2 years, those 2 years of mortgage payment offset, 5862.48 plus 3011.04 equals 8873.52, right? This is the cost of the buy down. This is going to be held in escrow and applied each month. Now, here's where our buy down feature kind of separates us from other lenders, and it's certainly a question you should ask a lender when this option gets discussed. What exactly happens to the funds remaining in escrow if a buyer refinances before that third year? And what we found with a lot of lenders is it's calculated as a fee, a cost of the loan, but not a fair way. Those monies are yours. They're refunded back to you. They are basically applied as a principal reduction, as a principal curtailment when you close on your refi. Now, thankfully, rates have fallen from those 20-year highs back in October and are expected to continue to trend lower as inflation continues to soften. So, hey, you're able to not only enjoy a lower than market mortgage payment for the next 1, 2, or 3 years until rates fall to a point where you can refi, but you're also able to enjoy an appreciating asset and all the other benefits that come with homeownership. So if you have any questions about these buy downs, about discount points, or if you want to discuss how to best position your offer based on your long-term financial goals, let's talk.